Welcome to the stock market, where grown adults throw money at companies they've never heard of and then act surprised when those companies somehow manage to lose all of it. We got three main types of people we got to keep track of: bulls, bears, and idiots like me who think they can time the market. Bulls are the optimistic ones who think everything's going up forever. Bears are the pessimistic ones who think everything's crashing tomorrow, and idiots are the ones who buy high and sell low while posting about it on Reddit. First off, let's talk about what the hell a stock actually is. A stock is basically a tiny piece of a company that you can buy, kind of like buying a single French fry from McDonald's and then claiming you own part of their kitchen. When you buy a stock, you're technically a partial owner of that company. Congratulations, you now own 0.0001% of Apple, which gives you exactly zero say in how they run things, but hey, you're an owner. Now, how does this whole circus actually work? Picture the stock market as the world's most expensive swap meet, except instead of trading baseball cards, people are trading pieces of companies while screaming at computer screens. The New York Stock Exchange is like the fancy mall where all the big companies hang out, while the NASDAQ is more like the trendy shopping center where all the tech bros gather to worship their favorite apps. Every day, millions of people wake up, look at some green and red numbers on their phones, and decide whether they're going to be rich or poor based on how those numbers moved overnight. It's basically gambling, but with more graphs and fewer free drinks. The price of a stock goes up when more people want to buy it than sell it, and it goes down when more people want to sell it than buy it. Revolutionary stuff, I know. Let's break down some basic terms that you'll need to sound smart at dinner parties. Market capitalization, or market cap for short, is basically how much the entire company is worth according to the stock market. You calculate this by taking the stock price and multiplying it by how many shares exist. So if a company has 1 million shares and each share costs $10, the market cap is $10 million. It's like saying your entire comic book collection is worth $1,000 because you have 10 comics worth $100 each, except Wall Street takes this math way more seriously. Companies come in different sizes, just like at the grocery store. Large cap companies are the big boys, the Walmarts and Apples of the world. These are supposedly safer investments because they're too big to fail, until they suddenly aren't and your retirement fund disappears faster than pizza at a college party. Mid-cap companies are the middle children nobody talks about, and small-cap companies are the scrappy underdogs that either become the next Amazon or vanish into the financial graveyard where forgotten startups go to die. Now let's talk about the people who make this whole system work, starting with buyers and sellers. When you want to buy a stock, you're not just walking up to Apple headquarters and asking Tim Cook if you can buy a piece of his company. Instead, you're buying from some other person who decided they've had enough of Apple's drama. The ask price is what the seller wants for their shares, basically them saying, "I'll take this much money but not a penny less, you cheap bastard." The bid price is what buyers are willing to pay, which is usually them saying, "How about less money because I'm poor?" Volume is simply how many shares got traded in a day. High volume means lots of people are freaking out about something, either buying like crazy because they think they found the next Tesla, or selling like crazy because they think the company is about to become the next Enron. Low volume means everyone's bored and probably playing video games instead of trading stocks. Volatility is basically how bipolar a stock is. A volatile stock is like that friend who's either super happy or completely miserable with no in-between. One day it's up 20% because the CEO tweeted something positive. The next day it's down 30% because someone sneezed wrong during an earnings call. Low volatility stocks are the boring friends who never cause drama, but also never do anything exciting. Bull markets happen when everything's going up and everyone thinks they're a genius investor. During bull markets, your uncle who works at Home Depot suddenly becomes a financial advisor because his random stock picks went up 20%. Bear markets are when everything crashes and the same uncle pretends he never gave anyone investment advice while quietly deleting his Robinhood app. Portfolio is just a fancy word for all the stocks you own. It's like your collection of Pokemon cards, except instead of trying to catch them all, you're trying to make money off them all. Diversification means not putting all your money in one stock, which sounds obvious, but you'd be amazed how many people bet their life savings on whatever company Elon Musk mentioned last week. Dividends are when companies actually give you money for owning their stock, kind of like getting paid rent for letting them use your money. It's usually not much, like getting a nickel every 3 months, but hey, free money is free money. Most people immediately spend their dividend payments on coffee and then wonder why they're not rich yet. The real fun starts when we get into modern trading apps. These apps made trading so easy that people started treating the stock market like a video game, except when you lose, you can't just restart the level. Robinhood showed up and said, "Hey, want to trade stocks with zero fees using an app that looks like Candy Crush?" Suddenly, everyone from college students to retired teachers was day trading during lunch breaks. This is where things get weird because social media completely changed how people invest. Instead of reading boring financial reports, people started getting stock tips from TikTok videos and Reddit posts. Someone would post a rocket emoji next to a stock symbol, and suddenly thousands of people would buy it without knowing what the company actually does. The meme stock phenomenon turned investing into entertainment. GameStop, a company that sells video games in an era when everyone downloads games, somehow became the most talked about stock in the world because a bunch of people on Reddit decided to mess with Wall Street hedge funds. These hedge funds had bet against GameStop, basically saying the company was doomed, so Reddit users coordinated to buy the stock and drive the price up just to prove them wrong. Short selling is when investors bet against a company, borrowing shares and selling them immediately, hoping to buy them back cheaper later. It's like borrowing your friend's bike, selling it, and then hoping bike prices crash so you can buy an identical bike for less money to give back to your friend. When short sellers get it wrong, they can lose infinite money because stock prices can theoretically go up forever, but they can only go down to zero. Short squeezes happen when short sellers get absolutely wrecked and have to buy back shares at higher prices, which pushes the price even higher, which forces more short sellers to buy back shares, creating this beautiful chaos that makes retail investors feel like they just beat Wall Street at its own game. It's like watching bullies get pantsed in front of the whole school, except the bullies are billion-dollar hedge funds and the pantsing costs them millions of dollars. Options trading is where things get really spicy. Options are basically contracts that let you bet on where a stock price will go without actually buying the stock. It's like betting on a horse race, except the horses are companies and sometimes the horses randomly explode or turn into unicorns. Call options mean you think the stock's going up, put options mean you think it's going down, and most people who trade options end up broke because they thought they were smarter than they actually were. Day trading is when people quit their jobs to stare at charts all day, convinced they can predict which direction squiggly lines will go next. Day traders are like gamblers who think they've found a system, except their casino is the stock market and their system is usually just astrology with extra steps. Most day traders lose money faster than they can make excuses about why this month will be different. Penny stocks are the sketchy back alley dealers of the stock market. These are companies trading for less than $5 per share, usually because nobody wants them or because they're about to go bankrupt. Penny stock promoters are like carnival barkers, promising you'll get rich quick if you just buy this one amazing company that's definitely not a scam. Spoiler alert, it's usually a scam. Initial public offerings, or IPOs, happen when private companies decide they want random strangers to own pieces of them. It's like a company having a garage sale, except instead of selling old furniture, they're selling chunks of their business to anyone with a brokerage account. IPOs are supposed to be exciting because you get to buy shares of a company on its first day of public trading, but usually the price shoots up immediately and then crashes back down once everyone realizes the company isn't actually worth that much. Earnings reports are quarterly report cards where companies tell everyone how much money they made or lost. Investors treat these like gospel, even though most companies have become really good at making terrible numbers sound amazing through creative accounting. A company can lose money, fire half their employees, and get sued by the government, but if they beat earnings expectations by 1 penny, their stock price will skyrocket because apparently that 1 penny proves they're the next Amazon. Technical analysis is when people draw lines on charts and pretend those lines can predict the future. Technical analysts look at patterns in stock prices and convince themselves they can see the future, like reading tea leaves except with more math. They have terms like support and resistance levels, which sound scientific but are basically just saying the stock usually bounces around between these two prices, so maybe it'll keep doing that, or maybe it won't. Fundamental analysis is when people actually look at what a company does and whether it makes money. This involves reading financial statements, understanding business models, and doing actual research, which is way more boring than just looking at pretty charts. Fundamental analysts are the nerds who actually know what companies do, while technical analysts are the cool kids who think they can predict stock movements by looking at patterns. Market makers are the people who keep this whole circus running by always being willing to buy or sell stocks. They're like the house in a casino, making money off the difference between buy and sell prices. Without market makers, you'd have to find someone who specifically wants to trade the exact number of shares you want to trade, which would be like trying to find someone who wants to trade exactly 17 Pokemon cards for your specific collection. Algorithmic trading is when computers do all the buying and selling using complex math that nobody really understands. These algorithms can execute thousands of trades per second, which is great for efficiency, but terrible for humans who still need time to think about what they're doing. Sometimes these algorithms go crazy and cause flash crashes where the entire market drops 10% in 5 minutes because a computer had a digital nervous breakdown. High-frequency trading takes algorithmic trading and cranks it up to 11. These are computers that trade millions of times per second, making tiny profits on each trade. They're like digital scalpers, buying and selling so fast that they can profit from price differences that last for milliseconds. Regular investors hate them because they feel like they're being cheated by robots, which is basically accurate. Exchange-traded funds, or ETFs, are like buying a variety pack of stocks instead of picking individual ones. Someone else does all the work of choosing which stocks to include, and you just buy one thing that owns pieces of hundreds of companies. It's the lazy person's approach to diversification, and honestly, it usually works better than trying to pick individual stocks because most people are terrible at picking stocks. Index funds are the even lazier version of ETFs. They just buy every stock in a particular index, like the S&P 500, which includes the 500 biggest companies in America. Index fund investors are basically saying, I have no idea which companies will do well, so I'll just buy tiny pieces of all the big ones and hope America doesn't collapse. This strategy has worked pretty well for the past 50 years, which is both encouraging and terrifying. So there you have it, every major stock market term explained by someone who probably shouldn't be trusted with a savings account, let alone investment advice. Whether you're a bull, bear, or just another idiot throwing money at meme stocks, at least now you know what all the fancy words mean when you inevitably lose your shirt. Remember, the stock market is basically legalized gambling with better marketing, so invest responsibly, diversify your portfolio, and maybe don't take financial advice from TikTok. Good luck out there, and may your gains be real and your losses be tax deductible.